Banks play a central role in the United States economy, providing a safe place for individuals and businesses to deposit money, access credit, and manage financial transactions. A bank is a financial institution that accepts deposits, makes loans, and offers other financial services such as checking and savings accounts, credit cards, and investment products. Banks help people save money, earn interest, and access funds when needed, while supporting economic growth through lending. There are several types of banks in the United States, each serving different purposes. Commercial banks provide services to individuals, small businesses, and corporations. They offer checking and savings accounts, personal and business loans, mortgages, credit cards, and online banking services. Commercial banks are typically the most common type of bank that Americans use for everyday financial needs. Investment banks focus on large-scale financial services such as underwriting, mergers and acquisitions, stock offerings, and corporate advisory services. These banks work primarily with corporations, governments, and institutional investors, rather than individual customers. They play a crucial role in capital markets, helping businesses raise funds and manage financial risks. Community banks and credit unions provide banking services at a local level. Community banks are often smaller institutions that focus on the needs of local businesses and residents. Credit unions are member-owned financial cooperatives that offer similar services to banks, often with lower fees, better interest rates, and a focus on member benefits. Both types of institutions are important for supporting local economies and providing personalized customer service. Bank loans in the United States. One of the main functions of banks is providing loans to individuals and businesses. Loans are borrowed funds that must be repaid over time with interest. Banks assess the borrower's creditworthiness, income, and financial history before approving a loan. Interest rates, repayment terms, and fees vary depending on the type of loan, the lender, and the borrower's credit profile. Personal loans. Personal loans are unsecured loans that individuals can use for a variety of purposes, such as medical expenses, home improvements, or debt consolidation. Because they are unsecured, the interest rates on personal loans are generally higher than secured loans. Personal loans can be fixed rate, where the interest rate remains the same throughout the term, or variable rate, where the rate can change over time. Mortgage loans are used to purchase homes or real estate. These are typically long-term loans, often ranging from 15 to 30 years, secured by the property itself. Mortgage interest rates can be fixed or adjustable, and borrowers usually pay principal and interest monthly. Banks also require down payments and evaluate credit scores, income, and debt-to-income ratios to determine eligibility. Auto loans are secured loans used to purchase vehicles. The vehicle serves as collateral for the loan, which means the lender can repossess it if the borrower fails to make payments. Auto loans have fixed terms and interest rates, usually ranging from 3 to 7 years. Banks may offer special financing for new cars, used cars, or refinancing existing auto loans. Student loans help individuals pay for education-related expenses, including tuition, books, and living costs. Federal student loans are offered by the government with fixed interest rates, flexible repayment plans, and options for loan forgiveness in certain cases. Private student loans are provided by banks or credit unions and may have variable rates and different repayment terms. Business loans provide capital for startups, expansions, equipment purchases, or operational expenses. Banks evaluate the business plan, revenue, credit history, and collateral before approving a loan. Business loans can include term loans, lines of credit, small business administration (SBA) loans, equipment financing, or commercial real estate loans. These loans help businesses grow while managing cash flow and investment needs. Credit cards offered by banks are a type of revolving loan, allowing users to borrow money up to a credit limit. Cardholders make monthly payments either in full or partially, with interest applied to any remaining balance. Credit cards provide convenience, rewards programs, and opportunities to build credit history, but mismanagement can lead to high-interest debt. Banks follow a structured process to approve loans. Applicants submit personal and financial information, including income, employment details, and credit history. The bank reviews this information to assess risk and determine interest rates and repayment terms. Once approved, funds are dispersed, and the borrower begins making regular payments according to the loan agreement. Responsible management of loans is critical for maintaining good credit and financial stability. The role of banks in the economy. Banks not only provide loans to individuals and businesses, but also support the broader economy. By lending funds, banks enable consumers to purchase homes, cars, and education, while helping businesses invest and expand. Deposits held in banks are used to fund loans, creating a cycle that stimulates economic activity and growth. Banks are regulated by federal and state agencies to ensure safety, soundness, and fair practices. In conclusion, banks in the United States offer a wide range of services, including checking and savings accounts, loans, credit cards, and investment products. Loans are a central feature, helping individuals and businesses meet financial goals, purchase assets, and manage expenses. Understanding different types of loans, personal, mortgage, auto, student, and business loans, is essential for making informed financial decisions. In the next part of this series, we will explore loan types in more detail, interest rates, repayment strategies, and tips for managing debt effectively in the United States. In the United States, loans provided by banks and other financial institutions are essential tools for personal and business finance. Understanding the details of different types of loans, interest rates, repayment strategies, and responsible borrowing can help individuals and businesses make informed financial decisions. In this part, we will examine these aspects in depth. Personal loans. Personal loans are typically unsecured, meaning they do not require collateral. They can be used for a variety of purposes, including medical bills, home renovations, travel, or debt consolidation. Interest rates vary depending on credit scores, income, and financial history. Fixed-rate personal loans provide predictable monthly payments, while variable-rate loans may fluctuate over time. Repayment periods usually range from 1 to 7 years. It is important to compare lenders, understand fees, and ensure the monthly payment fits within a budget. Mortgage loans. Mortgage loans are used to purchase homes and are secured by the property itself. In the U.S., mortgages often come with fixed or adjustable interest rates. Fixed-rate mortgages maintain the same interest rate for the entire loan term, typically 15 or 30 years. Adjustable-rate mortgages, ARMs, may start with a lower rate that changes periodically based on market conditions. Borrowers must also consider down payments, closing costs, property taxes, and insurance. Making extra payments or choosing bi-weekly payments can reduce the total interest paid over the life of the loan. Auto loans. Auto loans are secured by the vehicle being purchased. These loans allow borrowers to spread the cost of a car over several years, typically 3 to 7. Interest rates depend on credit history, loan term, and whether the car is new or used. Some banks offer promotional rates for new cars or refinancing options for existing auto loans. Timely monthly payments help maintain credit scores, while missed payments can lead to repossession and additional fees. Student loans. Student loans help cover tuition, books, housing, and other education-related expenses. Federal student loans offer fixed interest rates, income-based repayment plans, and options for deferment or forgiveness. Private student loans are offered by banks or credit unions and may have variable rates or stricter repayment terms. Borrowers should understand interest accrual, repayment options, and potential consequences of default. Proper planning ensures manageable debt after graduation and protects credit history. Business loans provide capital for startups, expansion, or operational expenses. Banks offer term loans, lines of credit, Small Business Administration (SBA) loans, equipment financing, and commercial real estate loans. Interest rates and repayment terms depend on business credit, revenue, collateral, and industry risk. Business loans can support growth, manage cash flow, and fund investments, but responsible management is crucial to avoid financial strain or default. Credit cards function as revolving loans with a set credit limit. Borrowers can spend up to this limit and pay monthly bills either in full or partially, with interest applied to remaining balances. Rewards cards, cashback programs, and travel benefits are common incentives. To maximize benefits and maintain financial health, users should pay on time, monitor spending, and avoid carrying high-interest debt. Interest rates on U.S. loans vary widely based on loan type, creditworthiness, and market conditions. Fixed rates provide stability, while variable rates may change over time. In addition to interest, loans may include fees such as origination fees, late payment penalties, prepayment penalties, and annual service charges. Borrowers should read loan agreements carefully to understand total costs including interest over the full term. Effective repayment strategies are essential for managing debt. Borrowers can prioritize high-interest loans first, consolidate multiple loans for lower interest, or make extra payments to reduce principal faster. Automating payments and maintaining a budget helps avoid missed payments, late fees, and negative impacts on credit scores. Understanding grace periods, deferment options, and refinancing opportunities can also provide flexibility during financial challenges. Responsible borrowing ensures long-term financial stability. Individuals and businesses should only borrow what they can repay, maintain emergency funds, and monitor credit reports regularly. Comparing lenders, negotiating terms, and seeking professional financial advice can help borrowers make informed decisions and avoid unnecessary debt. Banks support economic growth by lending funds to individuals and businesses. Personal loans enable home ownership, education, and major purchases, while business loans drive investment, job creation, and innovation. Deposits held in banks fund loans, creating a cycle that stimulates spending and investment. Strong lending practices and responsible borrowing contribute to the overall stability and growth of the U.S. economy. In conclusion, loans in the United States provide vital financial tools for individuals and businesses, including personal loans, mortgages, auto loans, student loans, business loans, and credit cards. Understanding interest rates, fees, repayment strategies, and responsible borrowing is essential to making informed financial decisions. In the next part of this series, we will explore loan refinancing, credit score management, and tips for maximizing borrowing benefits while minimizing financial risks.